Okay, welcome back everybody. Today is October the 21st, 2019. Today we're going to be going over Chapter 11. Um, we're also going to be doing Exam 2 preparation. And if you notice here, I've assigned Chapters 10 and 11 homework here. For Chapter 10, we're going to complete Understanding the Issues 1 and 2 and Exercise 5. And for Chapter 11, we're going to complete Understanding the Issues 1 and 3 and Exercise 2. I do apologize for not getting Chapter 10 homework posted last week. I meant to do so, but actually it slipped my mind. I'm not going to lie to everybody. It slipped my mind, so I apologize about that. But here it is nonetheless. So here's Chapter 10 homework. Here's Chapter 11 homework. Since the exam is next Wednesday, or not, I'm sorry, next Monday, not next Wednesday. The exam is next Monday in class. It's going to cover chapters 9 through 11. I'll give a detailed review today after we get through chapter 11. I'm going to move through chapter 11 fairly quickly and just kind of hit the main things. So it's going to be just moving through the slides pretty quick because I would rather focus the attention on the review as that's weighted as another 25% of your overall grade. So I want to get on that as soon as possible. So there was one other thing I was going to say. Oh, also with the homework for chapter 10 and 11 homework in regards to the solution, I want you to obviously try to do it on your own. Since the test is going to be on Monday, instead of waiting until Monday to post the solutions to chapter 10 and 11 homework, I'll be doing so on Friday. That way you have the weekend to look over what the solutions are and not struggle with the actual questions. And that way you can also focus your efforts on the exam as opposed to the homework. So just be on the lookout for that on Friday. I will definitely have those posted to you no later than Friday. That way you can begin with that. So with that being said, let's go ahead and get into chapter 11. So chapter 11 deals with the translation of foreign financial statements. The learning objectives are to define the functional currency and identify factors suggesting the functional currency, explain the objectives of the translation process, apply the functional currency translation process to a trial balance, and calculate the translation adjustment. Explain how the translation adjustment is accounted for and how a hedge may be employed. Describe the consolidation process and the sophisticated equity method, giving a particular attention to modifications due to translation. Once again, as you know from earlier, we didn't really get into the sophisticated equity method, so I'm not going to really touch on number 5 much. 6, apply the remeasurement process to a trial balance and explain how to account for the remeasurement gain or loss. And differentiate between the two methods for converting functional currency to the parent's or investor's currency and explain the circumstances under which each should be used. So foreign currency translation. What is a foreign currency translation? It's the process of expressing amounts denominated or measured in foreign currencies into amounts measured in the reporting currencies of the domestic entity. So relationships that could suggest the need for translation could be there's a home branch or a home office, and then they have a branch in another country. A parent-subsidiary relationship, so the parent has invested into a subsidiary, or the investor-investee. So these are the relationships suggesting the need for translation. And recall that foreign currency translation is just expressing amounts denominated or measured in the foreign currency into amounts measured in the reporting currencies of the domestic entity. So FASB statement number 52. This adopted a functional currency approach. Now this statement number 52 is going to focus on whether the domestic reporting entity's cash flows will be directly or indirectly affected by the changes in the exchange rates of the foreign entity's currency. So the main thing here is just know that it's a functional currency approach, and just and to know if there's going to be an effect on the domestic reporting entities' cash flows in regard to these rates being different between the two currencies. The functional currency, now according to the Accounting Standards Codification, Section 830, 1055.5, the currency of the primary economic environment in which the entity generates and expends cash. The number of factors must be evaluated in order to properly identify the functional currency. And these factors should be considered both individually and collectively in order to identify the functional currency. The main thing here with the functional currency is just, like it says here, obviously the primary economic environment in which the entity generates and expends cash. So it's just whatever that primary economic environment is. So now factors suggesting the functional currency. So we can look here at Exhibit 11.1. So on the left-hand side here we see the indicator. And then the following columns moving to the right. The next one is the foreign entity's currency, is the functional currency. And the parent's currency is the functional currency in the last one. So let's start here with the first indicator of cash flows. So cash flows are primarily in the currency of the foreign entity. Such flows do not impact the parent's cash flows. And that is if the foreign entity's currency is the functional currency. Now what if the parent's currency is the functional currency? Cash flows directly impact the parent's cash flows and are readily available to their parent. What if the sales price is the next indicator? So what if the sales price is the foreign entity's currency is the functional currency? Then the sales prices are influenced by local factors rather than exchange rates. And if the parent's currency is the functional currency, sales prices are influenced by international factors and exchange rate changes. The sales market, there is an active and primarily local market. That's if the foreign entity's currency is the functional currency. And the sales market is primarily in the parent's country. And that's if the parent's currency is the functional currency. Expenses, goods, and services are acquired locally and denominated in local currencies if the foreign entity's currency is the functional currency. And goods and services are acquired from the from the parent's country if the parent's currency is the functional currency. Financing. So financing is secured locally and denominated in local currencies. Debt is going to be serviced through local operations if the foreign entity's currency is the functional currency. Financing is secured primarily from the parent, or it's denominated in the parent's currency if the parent's currency is the functional currency. Now, intercompany transactions and arrangements. The intercompany transaction volume is low. Major interrelationships between foreign and parent operations do not exist, whereas the foreign entity's currency is the functional currency. And the intercompany transaction volume is high, and there are major interrelationships between the entities. And a foreign entity holds major assets and obligations of the parent if the parent's currency is the functional currency. So once again, these are the factors suggesting the functional currency. This is one of the important slides you really need to pay attention to right here when moving forward and studying for this test. So this is an important one here. Now, what are the objectives of the translation process? It's going to be to provide information that is generally compatible with the expected economic effects of the rate of change on an enterprise's cash flows and equity. So what's that mean here? It means that pretty much if there's these exchange rates are going to cause us to have to spend more money or less money based upon transactions that are denominated in these foreign currencies. So if there is an actual effect on our cash flows, then we need to take that into consideration. So that's pretty much what this translation process is doing, is trying to take that into consideration to show what those exchange rates between the different currencies will have on the company's overall cash flows and ultimately its overall equity. and reflecting the consolidated statements, the financial results and relationships of the individual consolidated entities as measured in their functional currencies in conformity with U.S. GAAP. So obviously we want to make sure that these financial results of the individual consolidated entities are ultimately measured in their functional currencies, and we obviously want them to follow U.S. GAAP as opposed to IFRS. Now, what are the expected economic effects of rate changes? Whereas the functional currency is not the foreign currency, so functional currency is not the foreign currency. So the foreign entity is a conduit for the U.S. parent's operations. So what is a conduit? It's like it's a pass-through, sort of like just like for tax purposes, if we think of like a sole proprietorship or a partnership or an LLC, these types of these forms of businesses or forms of organizations are known as tax conduits because ultimately the transactions ultimately flow through to the individual's 1040 return for the IRS at the end of the year. So it's just a conduit. So those are conduits. So that's what we mean by the foreign entity as a conduit for the U.S. parent's operations. It's dealing as like a pass-through to account for the parent's operations. The foreign subsidiaries' translated financial statements are identical to those statements that would have resulted had the transactions been originally recorded in the dollar functional currency. The financial statement relationships for the translated financial statements are identical to those that would have resulted had the transactions been originally recorded in the dollar functional currency. And the transactions of the foreign entity had an immediate or potential immediate impact on the dollar cash flows and equity. Therefore, the impact was included in net income. So when the functional currency is not the foreign currency, remember these transactions have an immediate impact on the dollar cash flows and equity. So since that's the case, it has to be included in the net income of the current period in which it occurs. And later on, we'll get into some instances in where that's not going to be the case and where it would actually be accounted for in OCI, which is other comprehensive income, which is a component of stockholders' equity until it's actually realized or another situation takes place. But we'll get to that later. Just know for the functional currency, not being a foreign currency, that it does have an immediate effect on its dollar cash flows and equity. So once again, has to be included in net income. So now, what is the expected economic effects of rate changes when the functional currency is the foreign currency? So in this case, the foreign subsidiary operates independently of the U.S. parent, not as a conduit. And rate changes are not expected to have an immediate impact on the parent's cash flows. So no translation gains or losses should be included in current net income. The translation adjustments should be classified as a separate component of other comprehensive income, other known as OCI. So there you have it. That's when the translation gains or losses should be included in OCI as opposed to in current earnings. That's when the functional currency is the foreign currency. So that's important to know for the exam too. So know the difference between when the functional currency is the foreign currency, how it's reflected in the statements, to whereas the functional currency is not the foreign currency. So know where these items are going to be reflected in the financial statements. So the translation process goes something like this little diagram here. So we're going to start by converting foreign financial statements to GAAP. And then from there we want to identify the book of records, or the local currency and the functional currency. So the book of records is pretty much like how are they recording for these transactions. So are the books going to be the local currency and the functional currency? So is the book records the functional currency? If it is, then the functional currency then we want to ask ourselves, is the foreign currency, or I'm sorry, the functional currency, I keep on saying foreign currency from these prior lessons, is the functional currency an inflationary currency? If it is, then we're going to apply the remeasurement process that is going to be shown later. But if it's not, we're going to use the functional method to translate, and then we'll end. So let's go ahead and move on to the next slide. Number 12, current rate the functional method. So this is one of the most important charts here. There's actually two of them as far as knowing what rates are used when translating these financial statements. So this is the functional method here with the current rate. So if we can see here on the left-hand side, we have the account, and on the other side is the translate with type that we type of translation that we use, or what type of rate we're going to use during translating. So as we can see here, the first account is assets and liabilities. So under the functional method, we're going to translate using the current exchange rate. So assets and liabilities are going to be translated using the current exchange rate. Revenues and expenses are going to be translated using the weighted average under the functional method. Equity accounts, excluding retained earnings, is going to use the historical rate on the date of investment in the subsidiary, which makes sense because that's the time that the transaction took place. Revenues and expenses happen throughout the time period, or throughout the accounting period, so that's why we're going to use the weighted average. And assets and liabilities are carried at fair value, so that's why we're going to use current exchange rates. Retained earnings is going to be the beginning balance translated using the rate on the date of the investment, and we're going to add the translated net income and then subtract the dividends translated at the rate on the date of declaration. So it's important to know dividends are translated on the date of declaration, not the day that they're distributed. It's on the date of declaration. Statement of cash flows, components translated at a rate in effect at the time of the cash flow, operations at rate used for revenues and expenses. So once again, really pay attention to this chart right here. The cumulative translation adjustment. The adjustment is not included in net income. The adjustment is shown as a separate component of other comprehensive income, OCI. And the adjustment may be recognized as a component of net income when there is a partial or complete sale or liquidation of the investment in the foreign entity. So as long as we're holding this investment or whatever it is that we're holding, it's going to be these adjustments are going to be included in OCI until they're actually realized or until we dispose of them. So it's important to know the cumulative translation adjustment is carried in OCI and not reclassified in the income until it's disposed of or a complete sale or liquidation of the investment in foreign entities, as is stated here. The direct calculation of the current period translation adjustment. So net assets at the beginning of the period are multiplied by the change in exchange rates during the period. So if you can see here, we have 0 functional currency times the 1.05 minus the 1.0. So that obviously this right here is the change in the exchange rates during the period. So this is going to equal 0. So the change in net assets, excluding capital transactions, that's important here. Remember, exclude capital transactions, is multiplied by the difference between the current rate and the average rate used to translate income. So 39,000 foreign currencies times the 1.05, which is going to be the current rate, minus the 1.03, right, and that's the average rate used to translate income, 1.03. That's going to give us $780. Now the change in net assets due to capital transactions, including investments by a domestic investor, multiplied by the difference between the current rate and the rate at the time of the capital transaction. So there's the difference between the two right there, is the current rate at the time of the capital transaction as opposed to the average rate used to translate income. And we can see here that that's 100,000 functional currencies. Foreign currencies times 1.05, which is the current rate, and then the minus 1.0, which is the rate at the time of the capital transaction, which is 1.0. So that gives us $5,000. So the current period translation adjustment is going to be $5,780, which is going to be the three of these summed together to give us $5,780. Now the difference right here, the change in net access excluding capital transactions, is going to be, obviously, this is talking about income here, what the company's producing, excluding capital transactions, which capital transactions we all know what capital transactions are. And obviously this one here, change in net assets due to capital transactions. So this is going to be like the investments of the domestic investors, stuff of that sort. So those are the difference. This is based upon operations. This is based upon capital and capital transactions. Consolidating the foreign subsidiary. Determination of excess is calculated in foreign currency. All intercompany balances except for intercompany profits and losses should be translated at the rates used for all other accounts. So what we're talking about here is this little chart here, using these rates. Profits and losses are translated at average rates or approximations. So it makes sense on profits and losses. Why they use the average rates, because we know that the expenses and gains, stuff like that is used. Income is measured with the average rate over the time because it occurs over the period of over the accounting period that's been accounted for. So the elimination entries to consolidate translated foreign subsidiaries. So I know everyone, hopefully everyone recalls these from chapters 1 through 4. So data alignment and EL eliminations follow the usual procedures, just as we did in chapters 1 through 4. CT elimination allocates the percentage of cumulative translation adjustment to the controlling interest. D&A eliminations generate CTE amounts, so the D&A eliminations generate these cumulative translation adjustment amounts. D, we'll go through the D and the A eliminations here. D, the markup or markdown of accounts translated at current rate. D, the investment in the subsidiary account charged at the historical rate. The elimination here is for subsidiaries' retained earnings charged at the historical rate. A, the depreciation and amortization expense translated at the average rate. Does that make sense? Because expenses are translated at the average rate. Contra accounts charged at the current rate, so the difference between the CTA amount allocated to the parent subsidiary. What are contra accounts here? We're talking about like allowance for doubtful accounts as a contra account to accounts receivable. So obviously that's going to be done at the average. At the current rate. Current rate, because it's based upon assets and liabilities, which is done at the current rate. Now IA and IS follow usual procedures. And intercompany profit, where the foreign entity currency is the functional currency, we're going to use exchange rate at date of original transaction to determine the amount of unrealized profit to eliminate. So just review these, be familiar with these. Just to note, I'm not concerned with you filling out a spreadsheet again like I was in chapters 1 through 4. So don't, just be familiar with really just what they are. Like I said before, if you know what's going on in the theory, and you know what stuff needs to be eliminated, and you can plug these in on an elimination worksheet fairly simple, as long as you know how to get to that point. So that's all I'm really concerned with. The main thing here is knowing the rates at which they are translated. Gains and losses excluded from income. So cumulative translation adjustment, obviously we've already established it. That's going to be excluded from income. Gains and losses attributed to the foreign currency transactions that are designated and effective as economic hedges of a net investment in a foreign entity. And intercompany foreign currency transactions that are long-term investments in nature. Okay, so these are the types of gains and losses excluded from income. And this is also an important slide here, moving forward. Consolidated foreign investments. So the cost method, if an investment was in a foreign currency, translate investment using the rate from date of acquisition. So obviously we know the cost method. When we purchase into it, we're going to use the translation at the date of the actual acquisition of that investment. And investment income, which is the cost method, we recognize, if you recall, revenue on the cost method is our income is earned when only through the receipt of dividends. So the investment income from dividends is going to be translated at the rate from the date of declaration. Remember, dividends are going to be translated at the date of declaration, and you will see that on the exam, just as a heads up. So know when dividends are translated, what date is used to translate dividends. It's the declaration date, not the distribution date. The sophisticated equity method, well, I'll read over it, but no, we haven't really been touching on this in this class. Record the amortization of the excess of cost over to book value, which is the average rate, and record a share of the current year's translation adjustment. The historical rate, the temporal method. So the remeasurement is necessary when the foreign entity's financial statements are prepared in a currency that is not the functional currency. The functional currency is in another foreign currency, or the functional currency is the US dollar. Another case in when remeasurement might be necessary, is necessary, is when the functional currency is that of a highly inflationary economy. Now, remeasure into functional currency before translating into the parent's domestic currency. The remeasurement process is intended to produce financial statements that are the same as if the entity's transaction had been originally recorded in the functional currency. And the resulting remeasurement gain or loss is included as a component of net income. So let's revisit this remeasurement process now that we've seen the use of the historical rate or the temporal method to measure into functional currency. So let's start here again. We're going to start by converting the foreign financial statements into GAAP. That's always the first step. Next step is always going to be to identify the books of record. So the books, the accounting books, the general ledger and stuff. What type of currency is being recorded on the book of record, and the functional currency. So is the BR equal to the functional currency? If it is, then is the functional currency, moving this way, is the functional currency an inflationary currency? If it is, we're going to use the historical rate or temporal method, and then it'll be done. If it's not the inflationary currency, we're going to use the current rate or the functional method to get the foreign currency, or the functional currency into dollars. I'm so sorry for keep on saying foreign currency instead of functional currency. Just hard habit to break from prior lessons. So let's move back down here. Book of records, the functional currency. So it's book of records, functional currency. We assumed it was last time. Let's say it's not this time. So is the functional currency the dollar? If it's not, use the historical rate or the temporal method to remeasure into the functional currency. And if it is, then use the historical rate or temporal method, and then we're finished. And this one here, obviously, if the functional currency is equal to the dollar, then we're going to go on back and say is the functional currency an inflational currency, and then follow along with where we were before. So I know I've just been quick in reading through the remeasurement processes, but if you take your time and just really go through the steps and see which way you need to go when there is like a fork in the road per se, as long as you know what the current rate functional currency is, and functional method. So that's what we're talking about here on this slide. That's these. Historical rate temporal method is going to be this one here on the next slide. So really, that's what the main thing here. If we understand the historical rate temporal method and the current rate functional method on how we translate it, then we should be pretty sound in these, as long as we know the roadmap as far as where to go and which direction to take, which ultimately leads us to which method we're going to use in the remeasurement process. So let's just take a look now at the historical rate and temporal method. So once again, we have the account on the left, and then remeasurement process using whatever the relative rate is. So let's start with the assets and liabilities. The monetary items are measured at the current values. Monetary items are measured at current values. Would be the current exchange rate. Not monetary items and not measured at current rates is going to be historical exchange rates. Now, what about revenues and expenses? Representing amortization of historical amounts, the historical exchange rate. Other income and expense items is going to be the weighted average exchange rate for the period, obviously, because Remember, income and expenses is happening over the period, over the accounting period, so we're going to use an average rate. Equity accounts, remember, excluding retained earnings, is going to be historical exchange rates. Retained earnings is going to be the beginning remeasured balance, plus or minus the remeasured net income or loss, less dividends, remeasured at the historical rates. And the remeasurement gains or losses is going to be a component of current period net income. So once again, just really pay attention to the historical and temporal method here, the current rate and functional method, the remeasurement process here, now that we have the full display, so we know which way to go, know what rates are used on the methods, and we should be pretty sound on it. More on the historical rate and temporal methods, the monetary items, rights to receive or pay an amount of money which is fixed in amount or determinable without reference to future prices of specific goods or services. That is, its value does not change according to the changes in price levels. So once again, for this chapter, main thing, try to read the chapter if you can. Obviously, that's the best way to learn the material, as it gives you a lot more explanation and stuff than these slides do. But really, the main things here to look out for: what suggests a need for a translation, FASB statement, obviously. Factor suggesting it, and then really just the roadmap slides with the two difference between the current rate functional method and then that of the historical rate temporal method. So that is all for the that's all for chapter 11 that I'm going to be covering. That's what I believe is the most important topics to cover. So with that being said, I'm going to go ahead and get on into the exam review next. I'm going to do it a little different this time. I'm going to do the chapter 11 recording separate from the midterm exam review, so that way you have the chapter 11 and then the review separate. So with that being said, I'm going to stop this recording and move on to the review. Okay. Welcome back, everybody, and now we're going to go over the review for Exam 2. And once again, Exam 2, as we can see here, is going to cover chapters 9 through 11. So let's see here. So for chapter 9, some of the material to be on the lookout for. So know the difference between what a denominated currency is, a functional currency, and stuff of that sort of. So just know what a denominated currency is and specifically. Also be familiar with what a measurement currency is. And so, and be in both in terms of knowing the differences between these types of currencies, whether they're denominated currencies or a measurement currency, be able to tell what type of currency it would be given a simple example. So, for example, if I said a U.S. company purchases a medical lab equipment from a Japanese company, and the Japanese company requires payment in Japanese yen. So in that case, be able to tell you what type of currency that is. So there's an example of what how it could be used as an example. So just know the difference between the types of currencies, meaning the denominated currency or measurement currency. Know when a company could be exposed to an economic gain or a loss on a transaction, what could cause them to be exposed to an economic loss or a gain on a transaction when dealing with, say, a U.S. company is dealing with a foreign company, and what what could cause them to be exposed to an economic loss or a gain on a transaction, and know how to actually calculate what the loss would be. Be familiar with what a foreign currency translation is. So be familiar with what a foreign currency translation is. So be familiar with what factors have influenced the development of accounting practices in various nations. So once again, be familiar with the factors that have influenced the development of accounting practices in various nations. Be familiar with what the responsibility of the International Accounting Standards Board is, also known as the IASB. So be familiar with what the responsibility of the International Accounting Standards Board is. Also be familiar with what challenges faces U.S. companies when trying to adopt IFRS. So once again, be familiar with what some of the challenges could be facing a U.S. company that's adopting IFRS. So be familiar with what the Security and Exchange Commission's, the SEC's requirements are from a foreign company who's seeking to sell securities on a U.S. stock market. So once again, be familiar with how the Securities and Exchange Commission sets its requirements for foreign companies seeking to sell securities on the U.S. stock markets. Be able to tell me how a company would say if they have a transaction to where they're purchasing inventory. Say a U.S. company is purchasing inventory from a British company, and there's some exchange rates here that's going to be factored in. Know how the U.S. company would account for that inventory transaction, factoring in the differences in the exchange rates. So once again, know how a U.S. company would recognize or record a purchase of an inventory per se from a foreign country. So with the effects of exchange rates in determination are taken into consideration as well. And also, same thing, flip side of that coin, know how the foreign country would account for the sale of the inventory of inventory to a U.S. company with the exchange rate factored in. So know how these companies are gonna account for it. Both the U.S. company and the foreign company. U.S. company is making a purchase of inventory, and there's from a foreign company, and there's exchange rates at hand. So we need to know how the company is going to record the inventory purchase, and also know how the company is going to record the sale of the inventory. That's the foreign company, how they're going to record the sale of that inventory with relative exchange rates at hand as well. Be familiar with forward contracts. And familiar, know how to, in particular, in dealing with forward contracts, be able to calculate a gain or loss to the holder and to the writer of a forward contract. who agrees to buy foreign currencies at a specific price. So for forward contracts, be able to calculate the gain or loss to the holder and to the writer of the forward contract who agrees to buy foreign currencies at a specific price. Now I will also be looking for what type of an entry would be made when this forward contract is made. And also be able to explain how the value of the forward contract would change over time. So once again, in dealing with forward contracts, be able to calculate the gain or loss to the holder and to the writer of the forward contract who agrees to buy foreign currencies at a specific price. I'll give you dates with different prices, and also know what the entry is to the holder at the inception of the contract, and also be able to explain how the value of the forward contract will change over time. And I'll give you a hint. This is going to be a short answer question. It will not be a multiple choice question. So the one dealing with forward contracts that I just went over with you is going to be a short answer question in 3 parts. And I just gave you what the 3 parts that I'll be asking you is. However, you must obviously know how to answer these questions. I'm not going to give you any more hint other than what I just have. So that's it for Chapter 9 questions. We'll move on to Chapter 10 questions. Know what a rate of exchange is and when one must be established. Once again, know what a rate of exchange is and know when one must be established. Be able to tell me what a direct quote is. And be able to tell me what a direct quote is. If I give you an example of a direct quote, be able to identify it as being so. Know what the forward rate in a forward contract is. Once again, know what the forward rate in a forward contract is. Know when a forward exchange contract is being transacted at a premium. So in other words, what causes a forward exchange contract to be transacted at a premium? What causes these forward exchange contracts to be transacted at a premium? I'll give you a hint. There was a little chart in the book in Chapter 10 that dealt with forward rates, whether they are what constitutes them being at a premium and what constitutes them being at a discount. So once again, know when a forward exchange contract is being transacted at a premium, or what causes it to be transacted at a premium. Know when a transaction involving a foreign currency will most likely result in gains and losses to the reporting entity. So once again, know when a transaction involving foreign currency will most likely result in gains and losses to the reporting entity. Know when the two transaction method should be applied. So once again, know when the two transaction method, we We spoke about this in chapter 10. Know when this type of a method should be applied. Once again, know when the two transaction method should be applied when accounting for foreign currency transactions. Be able to apply the two transaction method when, say, a U.S. firm makes a purchase from a foreign firm. Be able to apply that two transaction method to be able to tell me what a recorded value of the equipment would be. So if a U.S. firm purchased a piece of equipment from a foreign firm, be able to use a two transaction method to be able to tell me what the recorded value of the equipment would be. Also be able to tell me what a exchange gain or loss would be if a transaction is accounted for using the two transaction method. So for example, if a U.S. manufacturer sold a service to a foreign firm and then billed the firm and later received a certain amount of money, and obviously there's going to be exchange rates included here. Be able to tell me what ultimately on the settlement date what the total exchange gain or loss would be in using the two transaction method. And a little hint here is think about the rate that's used when the sale is recorded, and then once again the rate that's used at the settlement date. So just that's a little hint there. Don't make it more difficult than what it needs to be. So be able to tell me a little bit about a derivative. So what are some of the characteristics of a derivative? So an example of what I'm talking about a derivative would be it requires little or no initial investment, draws its value from changes in its underlying rate, stuff of that sort. So be able to just tell me about a derivative. And also be able to tell me what the two distinguishing characteristics of a derivative are. So be able to tell me what the two distinguishing characteristics of a derivative are. Be able to tell me what the time value of an option is. Once again, be able to tell me what the time value of an option is. So what is the time value of an option? It's the difference between what? To qualify for fair value hedge accounting, what must a company document? So be able to tell me what documentation a company must make in order to qualify for a fair value hedge accounting. Once again, what documentation must a company provide in order to qualify for fair value hedge accounting? If you recall from chapter 10, there was an example on the slides in which we showed the purchase of a merchandise on account or on credit from a foreign vendor. And then we showed at year end we had to make an adjustment to the accounts payable due to a change in the exchange rate. So be able to make a tell me what an entry would be included to adjust inventory at year end due to the change in the exchange rates. So once again, in chapter 10, there was a particular slide where we went through the process of where a U.S. firm purchased something from a foreign company, and it was denominated in a foreign currency. And from the point of purchase to the end of the reporting period or year end, there was a change in the exchange rate. So be able to tell me what journal entry would be required to adjust inventory at year end as a result of the change in that exchange rate. So we can know more or less. So obviously, meaning are we going to experience a gain or a loss for holding that transaction that's denominated in a foreign currency when the exchange rates change. So once again, be able to tell me how we adjust accounts payable at year end when there is a change in the exchange rate when we're still holding the transactions denominated in a foreign currency. And once again, there's a slide that we went over that can help you a lot on this question. Be able to tell me were gains and losses on a derivative instrument prior to the occurrence of the actual transaction and a hedge of a forecasted transaction should be reported. So be able to tell me where the gains or losses on a derivative instrument prior to the occurrence of the actual transaction in regards to a hedge of a forecasted transaction should be reported in the financial statements. Okay, now chapter 11 questions. If I give you an example of some transactions that are involving different currencies, of whether they are a functional currency or denominated currency, just be able to tell me whether a currency is a functional, denominated, or measurement currency, or whatever it is, based upon a scenario that I give you. In particular, a functional currency. Be able to tell me how to consider whether something is a functional currency. Obviously, given a scenario of business transactions, be able to tell me what type of a currency it is. Functional, measurement, whatever it might be. In this case, it's functional. So think along the lines of functional currencies within that transaction. Be able to tell me what type of events which suggest that a foreign entity's functional currency is the parent's currency. So be able to tell me what type of events would suggest that the foreign entity's functional currency is the parent's currency. So if currency exchange rate changes impact potential cash flows available to the parent and the parent's economic well-being, where should these results be presented in the financial statements? So once again, if currency exchange rate changes impact potential cash flows available to the parent and the parent's economic well-being, where should this be presented in the financial statements? So where should that be reflected in the financial statements? Be able to tell me the value of an inventory being held at year end. So, I'm trying to think of a way to ask you, give you a hint here. Be able to tell me what the translated value of an ending inventory to be included in a consolidated balance sheet at year end if of a U.S. parent, if the functional currency is something other than that of the U.S. dollar. A hint here on this, because I know I've kind of chopped this hint up on this question here, is at year end, use the market value as opposed to what the cost value was, because we're going to use the market value here. So in determining what inventory held at year end should be for the U.S. company, when it's not the U.S. dollar, when it's not that denominated in the U.S. dollar or carried at the U.S. dollar, be able to tell me how that inventory should be valued in the U.S. dollar as opposed to the other one. So how are we going to use that? The hint is use what the current fair value or current rates are. So if a foreign entity is deemed to be operating in an environment denominated by the local currency, the entity's capital stock should be translated by what type of rate? So know what an entity's capital stock should be translated. What type of rate should be used to translate an entity's capital stock? And that is if the foreign entity is deemed to be operating in an environment denominated by the local currency. What would the entity's capital stock be translated, or what rate would that entity's capital stock be translated at? Be able to tell me what rate of what rate of exchange should be used to translate dividends? So be able to tell me what rate of exchange should be used to translate dividends. So on what date do we use? What date's rate of exchange do we use when we translate dividends? I'll give you a hint. It's not when they're distributed. So what date's exchange rate do we use when we're translating dividends? Be able to tell me where exchange gains and losses that result from translating foreign currency financial statements into US dollars should be included. So be able to tell me where exchange gains and losses resulting from translating, not remeasuring, translating foreign currency financial statements into US dollars should be included. And what I mean by that, should it be an OCI? Should it be on the income statement? Or where should it be included for exchange gains and losses resulting from translating foreign currency financial statements into US dollars? Be able to tell me a little bit about accounting for a foreign investment under the cost method. So be able to tell me a little bit about the accounting for a foreign investment under the cost method. So a little hint here is how is it, what date is used, or what exchange rate is used to calculate investment income. So how are we going to account for that investment income? So another thing is, this is going to be another short answer here. Be able to tell me what currency exchange rates would be used to translate foreign currencies into US dollars. And what I will do is I'll give you an element that you would see on the financial statement, whether it be prepaid insurance or land or common stock, bonds payable, something of that sort. And what I'm looking for is for you to tell me what type of a rate will be used to translate that foreign currency into US dollars. You will be given a list to choose from, so you don't have to know off the top of your head. You should, in order to be able to answer the question, but I will provide you with a list of options of what rates to choose from. So once again, be able to distinguish what exchange rate would be used to translate foreign currencies into US dollars. And I'm going to pick different elements off the financial statements, and you tell me what type of rate is going to be used. And once again, if you use those charts I showed you, I think slide 12 and slide 20 out of chapter 11, you shouldn't have any problem with this. That's going to be pulled directly off those slides, so it should not be a problem. Now, obviously, you have to know what land or prepaid insurance is labeled as on that chart, because that's not labeled right on there. So you have to know what category that land and this stuff falls into in order to be able to get that answer. But answers are right there on those two charts. What's going to have slide 12 and slide 20 of chapter 11. And that is the end of the review. Just a heads up, the exam is 34 questions. I believe I will give a bonus question, which will make it 35. I have not picked the bonus question out yet. So there will be bonus, and there will probably be a built-in curve as well, similar to that of the last exam. I will let everyone know that moving forward, either this weekend or once we get in class on Monday. So please, once again, know I know everyone turned in chapter 9 and the derivatives module homework. I'll get those graded and back to you so that you have your grades on those. Remember, chapters 10 and 11 homework has been assigned. They will be due next Monday at 11:55 p.m. I will have the solutions posted so that you can see how they're worked out, and you can go ahead and get those turned in. I'll have those posted no later than Friday of this week so you can move on to studying for the final. And that way you can go ahead and get your homework submitted, get your credit for it, and start preparing for the exam 2. Remember, exam 2 covers chapters 9 through 11. Use this study guide that I just gave you, this verbal study guide, as your map or your framework for studying for the exam. It should help you out a lot. I've narrowed it down to pretty much precisely what I'll be asking you on the exam. However, you still need to put the time in to be able to answer the questions. And remember, the exam 2 is in class Monday. We're in 215 Mahood Hall, the Cole School of Business, at our regularly scheduled time at 4 o'clock. I do not plan on giving a lecture after the exam, because usually people are a little burnt out after the exam, so we'll plan on just getting on out of here after the exam. And if I do a little something, I won't expect you all to stay if I want to just touch into the next chapter a little bit. But as of now, I do not plan on doing so. So once again, chapters 9 through 11 exam next Wednesday, or gosh, I said it again. I'm sorry. Next Monday, regularly scheduled time. Homework's due next Monday as well. Please read these chapters, go over this review, and good luck on everyone studying. And once again, if you need any assistance or if you're having trouble with understanding anything, please call my office. If I'm not there, leave a message. I'll get back with you. Send me an email. That's the preferred method. Or just simply stop by my office between now and next Monday. Office hours are Monday, Wednesday, Friday, 9 to 12, and I'm always there. So feel free to come by, and I'll be more than happy to help you with anything you're having trouble with. So with that being said, I hope everyone has a good evening, a good rest of your week. Good luck on your homework. Good luck on studying for the exam, and I will see everybody on Monday.